And from the day I met Darren Farwell, I have learned something new weekly about investing money tax efficiently. And last week, we learned about the Trump effect, which I'd never heard about, and how it can impact on our investments. Today, Darren Farwell is with us again, so you can be sure you'll know more about investing for your retirement tax efficiently after this segment. Good morning, Darren.
Good morning, Marilyn. But I have to say, before I can move to anything financial, I have to talk about the experience of walking out of my place this morning, going to the car. I heard a bird chirping.
Nice, and it actually is lighter and brighter. It's, I think spring is in the air.
It sure feels nice.
Wyerton Willie, he was right. We are going to have an early spring. Yay!
I wasn't aware of that. I'm glad to hear. But this morning, Marilyn, now that we got that out of the way and my happiness at hearing a bird chirping and spring being on the way, I'm going today to revisit our 3 Ds to smart investing. We had talked about that some time ago, but I want to come back to it.
Please do.
And at the end, I'm going to relay a story about a woman who's had very long-term success implementing these 3 Ds in creating for herself a reliable tax-efficient income for life. In my professional opinion, the 3 Ds to smart investing are delegate, diversify, and dividends. Now let's go into these in some detail, starting at the first, though not necessarily in order of importance. Delegate. As we've said on this show over and over the years, Marilyn, you don't know what you don't know. According to a J.P. Morgan study recently, and yes, it's United States and we're in Canada, but some of the investor experience we could expect to be about the same. The average U.S. investor earns 2.3% rate of return in their retirement accounts. The research on the average rate of return that investors earn in discount, self-directed, do-it-yourself retirement accounts is even worse. And that's because while some of those investors do hold their own, even do well, a great many lose everything or almost everything, which of course brings those averages down. So let's take a look at that number. Say inflation is only 2% these days. Well, that's what the government statistics say, though it feels a lot more, when I go out shopping for groceries, when we're buying things, it feels a lot higher than 2%, especially when we see hydro bills, transit bills, and tax bills increasing at more than that. And by the way, inflation's likely going higher as the Trump effect starts to take effect. But let's just say it is 2%, because the government says so. Well, if you're earning 2.3 and inflation is 2, that means your money is actually growing only at 0.3%, 1/3 of 1%. That's really not going to keep your money growing ahead of the long-term ravages of inflation and taxes. And think about it, if you're getting 0.3 and on that you have to pay tax, you literally will have not only your money not growing, but your money's going backwards. You're actually putting your long-term lifestyle at jeopardy. Now, I understand that there's those out there who have the time, energy, inclination, and expertise to go it alone and do their investing themselves. And if that's how they wish to spend their time, they can do so without jeopardizing their long-term retirement. I also understand if you aren't confident about your finances, it's a challenge to find someone you can trust to help. But the stakes are too high to stick your head in the sand. The cost of health care will be skyrocketing, the cost to you. You're going to likely live a healthy, independent, and active life much longer than previous generations are. So it's critical to have your money working hard for you so you can keep ahead of and stay ahead of the ravages of inflation and taxes over time. So go ahead, Marilyn.
No, I was just thinking that, it seems that we're working really hard to put our money away, and then when we retire, some people just sort of leave everything behind and they don't pay attention. So the people that I was thinking about is to stay ahead of the ravages of time, the things you're saying, is that's when you should be most invested in dealing with someone who can make that money work, because you've worked so hard to get it.
Yeah, interestingly enough, a significant amount of the money you spend in retirement is money that you've earned earned on the funds that you had, that you brought into retirement. So keeping your money working hard for you after you retire is, as you said, actually in many ways more critical than the earnings you made while you were building those savings up.
Yes, it's exactly what I think your point took me to anyway, that adventure and the fact that you have to be more responsible to make sure that because it can't be replenished that easily.
Right. Yeah, you've got to make the money work hard.
Sorry,
it's got to work for
interrupted
you.
Yeah, because you always make me think.
Before retirement, you're working for the money, but after retirement, the money's got to work for you.
Exactly.
Yeah. The second thing is, of course, to diversify. What effect will the Trump effect have? Are interest rates going up or commodity prices rising? What's going to happen to Toronto real estate? High quality assets, as long as they stay high quality, will continue to go up over time. But in the short term, midterm, to maximize gains and minimize losses, we need to diversify. And when I talk about diversifying, I'm talking about, for example, if you had a $500,000 portfolio, you want to make sure you've got some cash and GICs, some low-risk bonds, and some stocks. That's diversifying across asset class. You want to diversify geographically, have some investments in Canada, the United States, and the rest of the world, both in stocks and in bonds. And finally, by style. You can have one advisor, but with your one advisor, you can hire different managers, so you get a different view of the world. You might want exchange-traded funds for passive returns, but active managers as well. So most people understand that we do need to diversify, but very important to diversify. And finally, last but not least, dividends. Own great businesses that pay you an income for owning their shares, a regular, reliable income that grows over time. And I'm going to go back to the example of Bank of Nova Scotia, just because it's one that I've talked about regularly, and most people are familiar with the name. If you own one share of Bank of Nova Scotia, you get paid a dividend of $2.92 per share. That's not a function of the stock price. The stock price can go up and down. Every year you're going to earn $2.92. And what's very interesting about that is over the last 10 years, that dividend, that income you receive, has increased on average 10% a year. So you got a 10% raise on your income every year over 10 years, and you didn't even go to work. So it's a very attractive story. In a world that's clamoring for income, because many of us are retiring and you can't live off the income from a GIC, dividends are a great alternative. Now, I said I would end with a happy story about someone who took advantage of all three of these things. Linda is a retired school principal. She retired 26 years ago. Linda came in to review her personal progress report on Monday. That's a report we use to compare where she actually is financially relative to where we planned she would be when she retired 26 years ago. Now, she's a principal, so she's got a great pension plan, fully indexed. She's got Canada Pension Plan and a little old age security that isn't clawed back. It's fully indexed. So I don't have to create a lot of income for her because she's got a lot of income. We started her with a dividend portfolio 26 years ago. She has earned an income of 4.5% from that portfolio that's increased by the cost of living every year for that 26 years, steady as clockwork. She started with $400,000. She now has $820,000. So has received her income every year and has significantly more capital than she started with. That's well ahead of where we even thought she would be. Linda followed all three of the rules for smart investing. She delegated. She got professional help. Yours truly. She diversified. We had dividend-paying stocks from Canada, the United States, and the rest of the world. And she received dividends. She paid herself a steady, tax-efficient income, and her capital has still grown well ahead of taxes of inflation. She is very happy.
She's given us a happy story, and I think you should be talking about the 4 Ds of investment. Good investment for me would include delegate, Diversifying, Dividends, and Darren Farwell. You always give me good information, and I hope my audience avails themselves of the information you're willing to share and advise people. Complimentary consultation?
Always a free consultation and free coffee and free parking.
And even though it's Family Day and very lovely out there, are you going to the office?
I am going to the office today, but not on Family Day Monday, Marilyn.
Okay, so if someone wishes to have immediate gratification and you want to participate in the 4 Ds of investment, then I would suggest you take this number down. I have it here, 416-863-7501. Be proactive and make your money work harder for you and keep more of it by making it tax efficient. That's what Darren and his team are all about, and this advice isn't just talk. He makes it work. He has a track record, been doing this since 1986, and all you have to do is call and ask for Darren at 416-863-7501. That's head office Scotia Wealth Management right downtown, but he'll pay for the parking and the coffee. Darren, thank you very much. I feel like I know more now than I did a few minutes ago, and I always feel that way. So compliment to you, because I think it's important that we wake up and know that everything we've done 10 and 20 years ago can be reevaluated and move us forward in a positive way.
It's good to be here, Marilyn. Enjoy your Family Day weekend.
Thank you. You too.